Well, volatility, yes, but I think we need to think about, volatility is not the same thing as markets going down.
Sure. Yeah.
And I think a lot of that relates into the growth part, which is, yes, we do believe growth is going to be slower than what it was this year globally. But a lot of that is intentional. A lot of that is because the sugar rush or the fiscal stimulus is sort of coming out. We're coming back more towards longer-term trend levels, at least in the US. And volatility, though, we do think will continue because if you look at late cycle behavior, historically, volatility does tend to rise with the lag as you approach late cycle, as the Fed keeps raising rates. Even if markets continue recording gains, those tend to come with a bit more volatility in both directions.
Yes, and the reason I bring up volatility is because it does seem as though we have this tug of war, if you will, between earlier in the week we had optimism that perhaps a China-U.S. trade truce was certainly making progress. And then now you have the fears over perhaps the trade fight that we've already had, the trade war, as some have characterized it, is already having such a negative impact. Do you think that is true?
Yes, and I think this back and forth is something we'll continue to see. And I think trade particularly is interesting because you can make the case that you get interim deals. That's something we've always maintained. But you can see there are some structural tensions and some questions which are much harder to get to an agreement. So I think what that means for markets is you will continue to see that volatility. And that's why a lot of our preferred ways of approaching investment allocations are about addressing that volatility. Sometimes it can be an advantage, gives you good shorter-term opportunities. We're absolutely looking for that. But it does mean diversification as a starting point is just singularly important.
I was going to say, what does that look like in practice? Where are you looking?
Well, we're starting actually seeing more opportunities in regions or sectors or parts of different asset classes. So less about sort of the big global equities or global bonds. I think we're a little bit more, we'd be quite happy being diversified at that level. But we still think in the equity space, the US can still outperform. In the emerging market space, we still think dollar bonds offer an extraordinarily attractive level of yield given where they are today. So, and in the currency market, you can see, funnily enough, sterling is one area where we think there's just so much bad news that it's a good example of where you can get a tactical opportunity. So I think there are opportunities. We just have to start looking a little bit deeper and more specific.
And you say funny enough because so many people are just so afraid to touch UK assets, I think, at this stage. Why are you perhaps a little bit more optimistic than the consensus?
Well, we're simply coming from, what sentiment looks like versus what's priced in. And I think for investing, that's always what it's about. For us, sterling, it's pretty much stayed in a 120 to 140 plus range throughout this last couple of years of Brexit debate. And the fact is, even at peak Brexit worries, it didn't sustainably break below 120 for a sustained period of time. So whenever we see the pair closer to 120, we just think the risk reward's actually quite interesting because, yes, it's messy. The headlines will keep going back and forth. But we have been in periods where there's been much more optimism than there is today. And frankly, that's all we need for the sterling trade to work.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.